Greetings. This is work on Forex, stocks, options, crypto, and all chart related trading. Today, we're going to talk about creating your own trading plan. Creating your own trading plan. This work is delivered by Twigbe Eizoge. You can contact me on 080 375 97085 for more training or account management. So this is my number, or you can contact me via email ehis22@yahoo.com or WhatsApp me on the same number. Advise to subscribe, share, and ask your questions. Today we are talking about creating your own trading plans, or how to create your own trading plan. Nothing succeeds except with a plan, and trading is not an exception. A lot of people dabbles into trading without first making provisions or planning their trades. Creating system isn't that difficult, but following it. And the goal of trading is to be able to identify trends as early as possible and to be able to avoid it from whipsaw or to avoid losing the trade. Like as we earlier know, the trend is when the trade goes in a particular direction, either up or down. For example, this is a trend, an uptrend. The market is going up. And this is another trend, a downtrend. The market is coming what? Down. So that's simply what a trend is. So the purpose of any market is to be able to avoid whipsaws. Whipsaws is when the market is directionless. It has no clear direction. And you are likely to lose during whipsaws. The hard part about those goals is that they contradict each other. And our task is to find a compromise between the two goals. So let's look at some of the steps you must put into cognizance when designing your trading system. First of all is the time frame. Like we know, there are different time frame. We have the 1 minute, the 5 minutes, the 15 minutes, the 30 minutes, the 4 hourly, the 1 hourly, the daily time frame, weekly time frame, and the monthly time frame. So you have to decide what kind of trader you are. Are you a 1 minute, 2 minutes, 5 minutes, 15 minutes trader? Are you a day trader? Do you prefer trading on a daily time frame? Are you a swing trader? Do you prefer the 4 hours time frame or the weekly time frame? etc. That's number one thing you have to consider. Consider the time frame that suits your person. This invariably means that if, for instance, you decide to trade on a 4 hourly time frame, ideally you have to be checking your trade every 4 hours. If you're a 1 hour time frame, you have to be checking your trade every 1 hour. Each candle represents what happens within the last 1 hour. On a daily time frame, each candle represents what transpired in the last one day. Same thing with weekly and the same thing with monthly or 30 minutes. So number two is to find indicators that help you identify new trends. So number two plan you have to put in mind is find indicators that help you identify new trend, e.g. moving averages. You can use two moving averages. For example, you can use two moving averages. You go to your chart, say moving averages. You can use a moving average of say 10, for example. or let's say 5. As the 5 minutes moving averages, and you can add another one, say 10. Change the color to whatever colors that suits you. So we have 2 moving averages, 5, which is the green line, and 10, which is the red line. So, and this will help to identify your trend. So 2 moving averages, one slow and one fast, and wait for the fast one to cross the slow one. That is, wait for the 5 minutes moving average to cross the 10 minutes moving average. Moving average crossover are the fastest way to identify new trends. A very simple and fast way to identify new trends. As you can see in our chart here, where the fast moving average crosses the slow moving averages, indicate that the trend has changed and it is up. And when it crosses down, it indicates that the trend has changed and it is down. So that is a very simple way to identify a new trend. Another thing to take note is that, or the number 3 factor to take note is that, when creating your own trading plan, is find indicators that help confirm the trend, like MACD, stochastics, and RSI. Take for instance stochastic. You add stochastics, go to the chart, you look for stochastics or RSI. Say stochastics, for example, click done. You see, only enter when stochastics confirm the direction of the trend. If the moving average crosses over, then wait for stochastics green line to also cross over. And when there are confirmations, then you can take the trade. You see confirmation here, you wait for this candle to close before entering the trade. That means the trend is finally up. So wait for confirmation. Or you can equally use MACD if you like. Let's get MACD and see how it behaves. That's MACD. Ensure that the MACD line is above zero and is heading upwards. So if you had used MACD, you would have been on the trade earlier. So according to the MACD rules, the trend began here. You have entered the trade earlier, but you would have exited at this point, enter again at this point, while the trend continues. You can equally use the RSI depending on your tastes. So the number 4 thing to consider is to define your risk. Define your risk. Define how much you are willing to lose on each trade. This is what we refer to as money management. You must define your risk. How much are you willing to enter with? Say 1% of your account. You may say, okay, in this particular trade, if I lose anything more than 1% or 2% of my account, of my equity, I will exit the trade. So that will determine the direction of your stop loss. You can equally define your risks by placing your stop loss behind the entering candle. That's a technical way of defining it, irrespective of the amount involved. So the number 5 points you have to consider is to define your entry and exit. By entry, wait till all your indicators, including candlesticks, matches That is, if you are entry buy, for example, ensure that everything matches, that your candle is up and your stochastics has crossed over and your moving average has equally crossed over. Everything must be in line. Wait for all the indicators, including your candlestick, matches. And by exit, you have to trade your stop. The moment the first candles puts you in profit, ensure that you put your stop loss at least 1 pip above your entry point to safeguard your what? Your profit. So if the market continue to move in your direction, for example, continue to trade your stop. Continue to gradually increase your stop loss position. Either by doing so technically or whichever form you decide to take, or by using support and resistance line to do so. So the number 16 to consider is to write your trading rules and follow it. You don't just say these things or cram these things. You must write it down. You must what? Write it down. It should be written and should be stuck somewhere in your computer or very, very close to your trading decks where you can see them every now and then. Are you getting it? And repeat it to yourself till it becomes a part of you. The number 7 factor to consider is to test your system. After creating your trading plan, you have to test it. You don't just start like that. You have to demo trade. You have to practice it. You have to move your candle, your chart one candle at a time and see how it has performed in the past. And if you are satisfied with its previous performance, then you do your honest recording. You record your wins, you record your losses based on your demo, calculate your average win and calculate your average losses. Do a honest record and see if it matches with what you want. If you are satisfied with it, if you like it, then go ahead and put some funds and start trading. So that is that about creating your own trading plans. In summary, I will advise you trade on daily charts, use 5 SMA, apply to a close, and 10 SMA, apply to a close. Use stochastics or use RSI. Apply your trading rules, that is enter long if the 5 minutes SMA or EMA crosses above the 10 minutes SMA and stochastics lines are heading up, and do the opposite if the 5 SMA crosses the 10 SMA and it is heading in the down direction. And your exit rules, target for example 100 pips in the opposite direction and exit when your trade hits your stop loss, 100 pip stop loss. So this is all about your trading plans. This is a summary of how your trading plan should look like. Trading plan doesn't have to be complicated. It just has to be very, very simple and stupid. It doesn't have to be complicated. It should be as simple as possible. So I normally say keep it simple, stupid. The most important thing is the discipline to follow it. Thank you very much. Remember to subscribe to this channel. We have a lot of other broadcasts and we do so at least once a week. So subscribe so that you'll be the first to get it. If you have any questions, feel free to ask your questions. Thank you very much. Remember to subscribe to keep the channel alive.